Would you explain to our audience the efficacy of a 2% target for inflation?
I wish I could, Tom, but you're absolutely right. We don't really understand why global inflation has been so low for so long. There's a lot of theories about all sort of different things, the income distribution effects on wages, particularly in America. There's the issue of internet purchases and retail and all the rest of it. But one thing is very clear is that if the central banks are adamant that they want 2% or thereabout, then they need to be even more accommodative at a time when fiscal policy in Europe certainly is not helping. In America is more than helping in a sense. So I think that the key takeaway of all that discussion is that central banks have been put in an impossible spot almost.
Equally important was a conversation last night of Eric Rosengren of the Boston Fed. And what he did, Eric Nielsen, is he put tariffs or import taxes on the x-axis. There's a short-term effect, and John Williams and the president of the Boston Fed are worried about the long-term effect. Can we say long-term that Trump tariffs will boost inflation?
No, not long term, right? I think actually there are two effects, as Williams said. There is a short-term one-year effect. I think, by the way, if I may say, I think he was a little generous towards Trump on his assessment of these negative effects or the effects on inflation. He mentioned a couple of tenths of percentage points. Now, in his old shop at the Fed in San Francisco back in February, they made a very detailed study that exactly said what would happen to inflation if they do what Trump is about to do now. That's on the overall CPI 0.3, but more importantly, on investment goods, it's 1 percentage point, which is huge at a time when investment have not been high in America because the companies have borrowed, as you know, to buy back shares instead of investing. So I think I was surprised how laid back he was on the inflation effect.
Yeah. But what John Williams was saying is that there's a negative supply shock, right? If tariffs, increase or stay as it is, but then you have inflation. I mean, in that scenario, what would the Fed do?
Well, I mean, strictly speaking, right, the central bank should look through the one-year effect on inflation, and then they should tighten because tariffs will lower the potential growth rate, thereby narrowing the output gap, right? So if you are shocking the economy by making trade less free, our potential growth rate goes down. That calls for somewhat tighter monetary policy, ironically, if you are a strict inflation targeter.
Yep.
I want to bring up a chart right now. Bring it up if you would. And this, of course, Kathleen Hays alluded to. And it's very simple, folks. It is the abrupt move in a rate cut that we've seen over the last number of days out to January of next year. We have surged almost up to the peak that we saw in March. Eric Nielsen, you're the optimist. Can you model a rate cut?
Yeah, I think they would end up cutting because I don't share the optimism that Williams said. He's right that, I mean, your colleague pointed out that the first quarter number were not quite as robust as they look. He kind of didn't really answer to it. Said, no, it's in a good place.
Okay.
But I think there is a case for a cut, right?